cost of my equity. And when you determine the cost of the debt, you're going to start with the risk-free rate, which is the yield curve, okay? And you know the risk-free rate is the real rate plus the inflation expectations. And since we were a corporation, and we're not that big of a corporation, we're about 10 billion in assets. I guess that's pretty big. We're about 10 billion in assets. And we have to go into the market and we have to raise debt. And it's going to cost us some money. So the first cost is going to be, we got to have the risk-free rate, and then we start adding on these risk premiums. Since we're not a $100 billion firm, but a $10 billion firm, the investors are going to be really concerned about default. You know, do we generate enough revenue to be able to service the interest and be able to pay back the investors on the bonds that we're issuing, okay? So they are going to want a premium for that default risk, okay? So we have to add that on. Then our bonds don't trade a lot in the market, so they're illiquid. So if the investors want to sell the bonds, it's going to be really hard. So they want a premium to compensate for that risk. And then since we are issuing 10-year bonds, there's a longer maturity, we need to be compensated for that long maturity because a lot can happen in those 10 years to the company. And if we're an international firm, we probably have currency exposures. If we're a corporation, we probably have tax exposures. Again, you got to add those, and there may be other risk premiums that you have to tack on and onto the risk-free rate to build the cost of the debt in which you're going to issue the bonds at. So I just came up with a theoretical approach. Risk-free rate is 2%, which is basically where the 10-year treasury is today. I'm going to add a 2% or 200 basis point credit default risk premium or default risk premium. 1 percentage point for illiquidity, 1 percentage point for maturity, and 1 percentage point for the rest of them. So I came up with a cost of debt of 7%. Now this approach can be totally modeled. It can be modeled within the software. You can get the data and you can run the analysis, come up with these estimates of what these risk premiums are, and to be able to calculate a cost of debt for the company. Boom, okay, one down, one to go. Then we have to figure out, since we're going to issue some stock, what is the cost of the equity in which we are going to issue those stocks at? Well, the model that we use is the capital asset pricing model, okay, or what is called CAPM. And I think maybe some of you in here, one of you, are going to do an Excel on the Benenga book on the capital asset pricing model or the weighted average cost of capital. So it's kind of, I'm going through all of this. And capital asset pricing model, as you can see again, starts with the risk-free rate. So if the risk-free rate goes up, in any situation, it's going to drive up the cost of debt and equity. If the risk-free rate goes down, it's going to drive down the cost of debt and equity. So the risk-free rate and the yield curve is extremely important in determining the cost of debt and equity for a firm. So I came up with another scenario. I used the same 10-year treasury yield of 2%, plus I used a 2 factor, 2x, for the beta, which basically means that the total return on the stock has moved twice as much as the market. Okay, twice as much, so it's a 2x factor. So our company is fairly risky. And we could say it's a technology company too. Okay, or it's a data analytics company that's publicly traded, in the marketplace. And we've been around, and we're a $10 billion company, and we both have debt and equity that's traded in the marketplace. But our total returns that we provided our investors over the years has moved twice as much as of the market in the up and the down. So we're more risky, we're more volatile. Then the return on the market, okay, it's going to be the beta times the return on the market minus the risk-free rate. So the risk-free rate shows up twice in this equation. Again, shows how important it is. The return on the market is really the S&P 500. That's the benchmark. that we are going to use. It's the benchmark we are going to use to calculate the beta, and it's the benchmark that we are going to use as the return on the market. We are going to adjust the long-term return on the market, which has been basically 10% per year over the last 15, 20 years, so it's a long time period. And we're going to subtract out the risk-free rate, and we are going to get what is called the market risk premium. Now, the market risk premium times the beta is called the market price of risk. And that's what you add to the risk-free rate to get the cost of the equity of the firm, of the funds that we are going to need to raise to be able to acquire this firm or implement this technology. Okay, so I got two, right? So I got cost of equity and I got the cost of debt. Excellent. Now what I need to do is I need to calculate what is called the weighted average cost of capital, which is going to be the discount rate in which we use to discount the cash flows to make our investment decision. Okay? And for those of you who are new to finance, you need to discount the future cash flows to the present and compare that value to the price of the cost of whatever you're trying to buy or build. And if it's higher, you accept it. If it's lower, you reject it. Okay? So to calculate the weighted average cost of capital, you need to look at the balance sheet of the firm, the assets and the liabilities. Okay? And the theory is that you want to match the maturities of your assets with the maturity of your liabilities. So this is called maturity matching or duration matching. Okay? And there are some examples in the book on immunization and duration in the Benanga book that goes over how do you manage the balance sheet, how do you manage maturity, duration, those types of factors. But this is a prototype balance sheet, and the liability side of the balance sheet is called the capital structure. Okay, it's the capital structure. It's how the firm's assets are being financed. Okay, and the theory is, and this is what the firms focus on, is I want to maximize my return on the assets, and I want to minimize the cost of capital. So I can maximize the spread between return on capital and cost of capital. That's it. That's the game of capitalism. Okay? If I can maximize the return on my assets and minimize the cost of my liabilities and maximize the spread between the two, I'm going to maximize stock price or enterprise value, and that's the goal, is to maximize stock price value. So I got a $10 billion firm. Our short-term assets are $2 billion, medium-term assets are $3 billion. My long-term assets are $5 billion. The way that I'm financing these is I have $2 billion, for the short-term liabilities, so they match. My medium-term liabilities are $3 billion. Okay, that matches. And my long-term assets are being financed by long-term bonds and stock. Okay, owner's equity. All right, and $2 billion of bonds and $3 billion of owner's equity. Now, a typical firm, its capital structure looks like this. 30% is financed through owner's equity, either on a book basis, book value basis, or a market capitalization basis, which means what are these shares outstanding on these securities times the price is going to give me the market capitalization or the market value of those stock. Same thing with the bonds. What is the price of the bonds times the number of bonds outstanding is going to give me the market value of the bonds. Most industrial firms are 30% equity and 70% debt, which is fairly, it's high debt, right? High debt to equity. Plus, there's an incentive to use debt over equity because equity costs more in returns to the investors and cost of underwriting. But the federal government was nice enough to give corporations the ability to deduct the interest on the bonds to tax deduct the interest that they pay to bondholders. So there's an incentive to use more debt over equity, and firms do, because it's cheaper. The cost is cheaper. So I have the cost of the equity over here, and I have the weight of the equity. Okay, boom. I have one variable down. Okay. Now what I have is the 70%, which is the debt. All right. So what I did was I basically added up the debt and divided it back to get the percentages. Okay. So it's really just the debt portion. I have 30%, 40%, and 30% between long-term, medium, and short-term debt. Came up with the weights. It's costing us 5% on the short term for the debt. It's costing us 7% on the medium term and 9% on the long term. So I basically just calculated a weighted average of the cost of the debt portion, which I came up with 7%. And then multiplied that by the 70% to get 4.9. So basically our cost of debt on a weighted average basis is 4.9% or 5%. The cost of the weighted cost of the equity is 5.4%. So basically our cost of weighted average cost of capital is 10.3 or 10%. That becomes the discount rate. Okay, any questions on that? Any questions on that? Okay, that's key, right? And the key is this capital structure has to minimize this capital structure. These weights that you're seeing right now are the target weights and the optimal weights that minimizes the weighted average cost of capital, minimizes the discount rate, okay? So here's the basic discount